All right. Good morning, everybody. So as you can see what's happening around the world, we're red on the screen. Asian markets are down the most, and the US markets are down the least. This week we have over 300 companies reporting earnings, which may sound like a lot. It's not the biggest week, but I would argue that it's nearly one of the most important weeks in the earnings quarter. So certainly something to keep in mind that today we're going to be getting more banks, and some of these banks, their CEOs have the power to move markets. For an example, Jamie Dimon, right? So how he talks about his own company is only going to be part of it. How he views the markets and the economy and the state and the health of the world markets and what he talks about absolutely has the power to move markets. But then we've got really big names that are reporting too and can take not only their own sector, but the index that they're in. It can take it for a wild ride. So just kind of keep that in mind. There are some traders who will discount everything, right, and just run solely on the probabilities. I say, why ignore data? You can be a probabilities trader all you want, but you'd still want to recognize the potential impact that we could get from earnings releases, economic data, things like that. So we don't really have a lot going on the intraday as far as economic events go. We do have the manufacturing index, but as you can see, it's not listed to be highly impactful, or, this is more of a historical precedent. Does it consistently generate volatility or not? That's where that gauge comes in. So it's not telling us that it's going to be highly impactful or highly volatile. It's just reminding us that a particular meeting or event has a history of being volatile or not. China did not increase stimulus. They just stayed firm where they were at, but did give wink and a nod that they might, provide more stimulus a little later on. So that's something to think about as well. That's going to affect the plays like BABA, Baidu, JD, BDD, all those China ADRs. And the 10-year got back below 3.8, which is a really big deal. All right, so we're looking at crude here. We've been in this range through most of the year, kind of expanded it a little bit if we were to consider it like the strat with the megaphone pattern. So the range has gotten a little wider. We, kind of dipped out the bottom here and we expanded a little higher out of the top, but we're still just sitting in the range. This range is not expected to change anytime soon, right? If we were to use something like a linear regression line, something like that, I'm sure it would still be pointing to the downside, depending on where you start it. We'll just use, say, 2023 data. I know I got one in there. course, when I want it, right? Maybe we'll just do it on Thinkorswim. I know we got it over there. All right. So that's 2023, right? And it's running a little bit of least squared methods. But you can see the slope is very clear, right? So range or no range, the slope is still to the downside. It's not expected to change anytime soon. I am on a weekly, so it's something to keep in mind. But bigger picture, we're just not going anywhere. So that continues to be a great neutral trade. You know, you might have to rebalance once in a while on your deltas, but otherwise, it's just a good trade to go nowhere. Remember, it's the boring, sleepy ones that you want to do, you know, your iron condors and things like that. We do have additional auctions today at 11:30. So on the other side of lunch, you should be good to go for your 0-day trades. Volume is a little light, which is mildly concerning. You got to kind of consider, why is it light? You know, there's the data that we have on deck isn't anticipated to be really big or impactful, right? It's not like CPI or non-farm payrolls. So why is the volume so light? I looked around, I really didn't see anything drastic or extreme, and we don't have a market maker move. So we just want to note that it is light. Continue to, you know, be cautious, continue to look around, see what is up, why is it light. Maybe nothing happens at all. Could be that there's some markets closed around the world for whatever reason, holiday, election, banking, could be a number of reasons. We have an MDP so far. We are underneath the daily pivot. We ended that streak of continuous missed daily pivots. Friday afternoon, we did finally come down and tag the daily pivot. So that these purple lines here that are marked with weekly pivot and daily pivot, it's the old floor pivot formula. That's what is deriving those lines, right? So the old formula, it's been around forever. There's two styles: open, high, low, close divided by 4, because there's 4 points of data. And then there's just high, low, close divided by 3, because there's 3 points of data. That number is where these purple lines come from. And that can be for a daily, a weekly, an hourly, 15-minute, whatever you want. I use daily and weekly. They're more than enough for me. And that's the pivot points that we're keeping track of. And we can see last week, right, that we didn't hit the daily pivot until Friday. If you've followed up on this, right, I've mentioned it more than once that if you want to learn about it, it's not mine to teach, but you could easily find it on YouTube or something like that. The day that we had a missed daily pivot isn't really the one that we're focused on, right? It's what happens after that and what it means when we finally make contact with one. Here's the weekly chart. We continue to ride higher than the 10. So far this week, we are inside last week's range, which means we're on pause still, giving that 10 time to catch up with us. We had paused and consolidated for nearly a month, right? And it's trending higher. Same thing we just did over there on TradingView. It's trending higher. And if we were to use something like OCR analysis, then the big outside expansion bar from last week was a lower low, higher high, higher close. and that would be signaling a resumption of the trend. But so far, looking at it on a weekly, we don't have any data yet. I will say this, if we had gapped up and we're opening this morning higher than the high of last week, I would be more bearish. I would be more cautious, kind of like back here, right? Where we closed on the week there and then we rallied up and we opened way up there on Sunday night and we just kept on going. I would be more bearish if we had opened up there, but we didn't. And in fact, if we opened down like this, anywhere in that lower zone, I'm actually a little more bullish because of that. Not always, right? But in this circumstance with how we closed last week. The range for today, the 21-day average daily range, is about 92%, which comes out to about 42 points. Now, if you have been kind of keeping track of our range on a day-to-day basis, that number really doesn't feel like it's enough, right? 0.92%. But that is the 21-day average right now. So to the downside, that's 45.15. And then below that, the weekly pivot point, and below that, the 10-week, or excuse me, the 10-day. I'm pretty sure that's the 10-day. Yep. And below the 10-day, then we would get to 44.94, which is the full ADR to the downside. Someone asked about a double bottom this morning. I'm more inclined to like a double bottom if we go the IBD's route. So IBD, or Investors Business Daily, would say that once you've got your low set back here and you leave that zone and you come back, you don't want it front run like this. You actually want it to go through and break that pivot point. Now, when I was newer to trading, I was under the belief that it was supposed to stop at the same location that it had stopped before, right? So it comes down, it sets that low, goes away, comes back, and it was supposed to bounce right off that zone. That was my understanding when I was newer. So I would try to trade it that way, right? I'd put entry orders around that area and I would try to trade the bounce. And then it would do things like it did earlier, where they front run the trade and never comes down and hits the line, or it would shoot through it and run me over, stop me out, and then it would go. The way that Investors Business Daily talks about double bottoms is that they are classic bear traps. They're supposed to go lower than the previous low to convince all the bears that we're actually going down. Once they pile into it, then do the rug pull, pop it to the upside, squeeze them and make them puke their trade up. And if you're short, you have to buy to close. It adds to the buying and you get that big monster rip back up in the other direction. So that's the kind of double bottom that I like, because you get that really fast move. When they front run it like this, it leaves the door open for a continuation down. So I don't like that double bottom as well. Yeah, makes sense. Makes sense to me. $10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We're coming off of those highs, heading back to the lows. And keep in mind, the low that you see here is not the low that we will have, say, by next Monday, right? Because by next Monday, we'll lose this Monday's low, unless we come back down and revisit that between now and then, right? We've had that talk now for about a week and a half. I continue to point this out. I'm hoping if I do it enough, it'll start to stick. We don't really have a classic shape if I was to be a little forgiving, I would say maybe it's a lowercase b shape, but that's being really generous. We don't have much of an air pocket until we get through that 44.88 area, which is where it starts to get really shallow here. Otherwise, it's just a mess, right? One thing you have to get comfortable with is the idea that your tools or your indicators may not always give you a clear signal. Sometimes they're, well, no, not even sometimes. Most of the time, they're just going to be giving you noise, right? And it's your job to kind of weed out when is it actually giving you a signal and when is it just noise. We have a VPOC now over our head. Friday set a point of control that we have not yet come back to. The one from Thursday, we took off. Right, I took off. So I'm going to put it back for a moment just so we can have that talk about what do we do with these lines and when do we take them off? Now, it's not about right or wrong. It's more about what kind of analyst are you, who taught you, and then what do you want to do with it? You're going to find that a lot of things when it comes to analyzing the markets are nothing more than you making a conscious decision about which way you want to do it, and then continuing to be consistent in your approach and do it that way over and over. So when do we take this line off? It's a VPOC, it's a virgin point of control. It hasn't been touched until finally it does, right? Price came down here and hit it Sunday night. Do you take it off Sunday night? Do you take it off Monday morning here when it hit it over here? Or does it only count if it's hit in the RTH session? And what about if it hits it like it did here, but it doesn't close below it? Do you take it off then? The answers to any of that is you grab a cup of coffee and you go back and you review old examples where it tagged but didn't break down, or it broke through and rallied back up. See how price finished off the day. Did it continue to react to the line or not? Is it reacting to the line at all? Maybe it's not, it's just coincidence that there's a line there and price is turning. There's no right or wrong way to do it. Me personally, I tend to leave the line on until the next day when I come in and do my morning briefing. I don't trade these lines as if there's some sort of signal to get in or out anyways, right? So for me, I want to know where the line was all day. So I just leave it on there till the end of the day, which usually means coming back into my office tomorrow and taking the line off. That's my approach. It doesn't make me right. It doesn't make anybody else wrong. So any of those choices, or maybe even a choice I didn't mention, any of them are valid. Just try to prove why you're doing what you're doing and then continue to do it consistently. And at some point, if you don't like it anymore, change it and do something else. We did talk on Friday about this week's expected move. That morning, the box that we were looking at, or the range that we were going to be dealing with, was about the same size as last week, but the box isn't set until Friday at the close. And of course, I do my morning briefings in the morning. So where are we now with that box? Yeah, they didn't change much, right? By the end of the day, the projections for the week that we're in now isn't much wider, bigger, smaller than it was last week. So not a whole lot has changed on the volatility expected move. Now that is set in stone now, right? That range won't change because we're using what it was on Friday at the close. If you were to go in now, however, and look at this week's range, it's about 54.25 to the upside and 54.25 to the downside. It's about 108 total from high to low end. That's not what it was Friday at the close, right? This is constantly changing, and it will change every day all the way up until Friday at the close. All right, so we still got the 10-year below that 3.8, but it is trying to get back up there. Still holding structure at 3.75. It's not the idea that we have to get below that line. It's more the idea that it would be good to get below the line, but at the very least, we need to stay below this quarterly line, 3.831, right? And then the other thing is, even if we do stay below 3.8 or 3.83, how we move around on the intraday is going to have impact on the markets that you're trying to trade too, right? So you really don't want to see that kind of move, those big, sharp, sweeping moves up or down. If we do start to see these downside moves, that would be, tailwind for, say, the S&P or the NASDAQ, a push to the upside for those markets because of this kind of fast, sudden drop. But if it happens to be a fast, sudden rally, then, expect the S&P or the NASDAQ to hit some resistance or to begin to fade, right? That it would be a headwind. Same thing with the dollar. So if we get another sudden, quick drop to the downside, we're going to consider that, positive for the market. If it starts to make those same kind of moves in reverse, start heading back up, then expect that to be headwinds for the S&P and the NASDAQ. Same thing with US dollar Japan, right? Now we're not talking tick for tick, right? You don't want to be all zoomed in on this thing super tight, watching, 1 minute candles on the 10-year and the dollar and the US dollar Japan for every little tick up and down, trying to figure out where the S&P and the NASDAQ is going to go. It's not like that, right? It's not a teeter totter where one side goes up and the other side has to go down at an equal and consistent amount. It's not like that. All right, Amazon is down slightly this morning at 134.25. That still puts it inside day. So what we want to watch for here, this is a really nice setup. It's not the best one out of any of these, but whatever. We closed there. We faded down in the pre-market. We're still holding above this 134.06. It's got a lot more structure to it because it wasn't just Friday's open, it was Thursday's open as well. Maybe not to the penny perfect, but it's a pretty solid level. So what we want to do is see that bounce. Think about how it closed on Thursday, faded down, opened on Friday, made that big loop. That was a nice tradable opportunity. You got the same thing again this morning, only the box is bigger, right? So On Thursday, that high was set pretty easy, and that's basically where we closed. But we closed on Thursday there, opened on Friday here, did all that running, and closed just inside that Thursday level. Now this morning, we're getting a chance to do it again. If we were only using OCR, then we've got IX10 at this point. But that big long wick kind of negates the whole idea of OCR or of inside day for an IX10 if we were doing it in a more traditional format. Either way, I still believe that Thursday's range is the control that we want to keep our eye on. And you got a nice little bounce opportunity here this morning at 134. If you're day trading options, one of the things that you will eventually get used to is that your calls trade better if you buy those calls when the market is still falling, right? And your puts trade better if you buy them when the market is still rising. Because as soon as the options market recognizes that support has been found and we start to rally, they start stripping all that volatility out of it, right? And the price just completely changes on the calls. The same thing when the market realizes that we've hit resistance and we've started to fall. The way that they change the pricing in those puts, it's not that you shouldn't buy puts if we're already going down, or you shouldn't buy calls if we're already going up. I'm just saying that you will find they monetize so much better, so much faster if you get them when the market is doing opposite of what you want it to do. So with Amazon, we got that opportunity to buy, some calls here right on a line at the 134. Simple target, Friday's high. Even using the midpoint for like first target. And if we do break to the downside, target 1 would be Thursday's low. Target 2 would be gap close from Wednesday to Thursday. Worry about some resistance at 131, or the support, whichever way you want to look at it, 131.50. All right, Tesla's up this morning. It closed at 281.40. I'll just do is round up a little, and it's at 286. Call it 287. 287 is entirely outside of this like V shape that we have here. That's where we're going to be opening this morning. Really nice setup. The idea will be that we want to see this fade down a little bit at the open, bounce on Friday's high, and then make that continuation to the upside. If it doesn't bounce, then you've got your short play, right? It would be the idea kind of like back here where, we close there, we gap up the next day and we fall back, or, we close there, we open way up here, we fall back. So this morning, since we closed there and we're opening above that, we do have the capacity to just fall back down, but it doesn't have to, right? It can close there, open outside the range like that, which is what we've got this morning, and it could just continue to run all day. Just keep in mind that is a TRB setup and the target has been met. The target is to get back to the 285. It already did all of that. And now we're opening above it with that 290. So where could we go to the upside? That's simple. We can just measure this range. Project that to the upside. 50% is 293. 100% gets us to 302.60. Now, some will argue, hey, should should I use the wick here, or, you know, just the body? What about this wick up here? There's no wrong way to do it. If you've gone through some candle mechanics at some point, they will tell you that most of the time the body is going to have like 70% of all of your volume, right? That's not always true, but you know, that holds true most of the time. And so if you're trying to analyze what's going on within a candle, you probably want to keep track of where most of the volume happened, which means you would be using body logic. The main approach to this is to be consistent. So if you measure with the wicks, do it all the time. And if you don't use the wicks sometimes, say like a dark pool print gives you a really, really long, big, crazy, wild wick, then just acknowledge that you're not using it because of a dark pool print or something, and otherwise just be consistent. Look at the numbers up here. Just for an example here, I'm going to move this 293.23. What if I only used the lower end of the body, 291.5? I mean, yeah, that's a little bit of a change, right? But is it that bad? It's not too bad. Or up here from 293.83 to 293.23. It's not that much of a difference. Be consistent. That's all that matters. We still have this gap close, by the way, gap that needs closed. Because it has not been closed yet. Zoom into that for a moment. Simple enough. We closed up here and we opened it down here, and we did not come back up and tag that line. Now, some analysts will say that as soon as we get into this candle's zone or range, that the gap has been closed. I'm not that kind of person. As far as I'm concerned, if we closed at 287.81, then the gap isn't closed until price comes back up to 287.81. At least, right? If we can overshoot that, then it'd be even better. So until that happens, that gap isn't closed to me. Now this morning, like I talked about, 287, we've been up there this morning, and look at that. We still, still not closed. We're going there. That very well could just be, you know, destination at this point. Inevitability, so to speak. The main thing at this point, because we already know we're going to go there, right? It's no longer a maybe. We're going there. The thing will be is, will we get above it? And then will we close above it? That's going to be the next thing that's going to be very important. I think we're going to get all-time highs before we see, say, 50% of this range again. So, you know, if you're asking the question like, what's more likely, we see all-time highs or we see the 50% mark first? I would say we get all-time highs sooner than we see that 50% mark again. That's just me. All right, Apple's up a little bit this morning, depending on if you want to run with the bid or the ask. We're still at above 191 and we closed at 190.70. So we're still inside week. And we are still inside day. On Apple, got this really nice setup here for an inside day breakout. We are IX10 from this 712 candle. So if you want to be conservative and wait, then you're going to want to see price get above 190, 170. And we're going to be looking for the strat and his machine gun pivot reversal, I believe is what it's called. I always screw it up, and it's not his fault, it's just mine. His logic would be during this fade back for everybody that was going short, where would their stop be for that short, right? So if you went short on that day, your stops would be, above that high of day. And on this green day, you were fine, so they are still there. And then if you added to your short or went short this day, your stops would be up there, on and on, right? Same thing there and same thing there until the move started. Well, it only triggered through these two, and that was it. That's where everything stalled out. Now we're IX10. So if we break this high and we get into those stops, which could propel us into those stops, which could propel us into those stops, which could get us through to high a day or a high of a year, right? It's not a clean example, certainly not the best one we could ever find. And it's not my logic, right? That's the strat. It's not mine. So if you disagree with it or don't like it, take it up with him. I don't want to hear it. But we're going to be looking for Apple to resolve this IX10, right? And IX10 is just inside day, multiple days in a row. The thing is, the more time you stay range bound, the more energy you develop. We learned that through using the RSI Laguerre indicator, right? So now we're going to be getting our third day today, still so far inside this range. And at some point, it's going to come out of that range. Now, if it's a really big range, it's not even all that great, right? So like back here, we spent 2 days inside the range and we wicked out of it, and it wasn't even that great. And yet look at the follow through for not being so great. This is not a bad follow through, right? But this is I would argue it's a tighter range, but really, I mean, if I drag that box over, it's probably not that much tighter, huh? Yeah, no. It just looks better because it's a doji, but really it's not that much tighter of a range. That is a tight range. So we'll see. That gives Apple the capacity to really give a strong push today, 195, easy, right? All it's going to take is a little spark. So it doesn't owe us that move. There's no momentum here. There's no true, trend in the short term. If we were to zoom out, then obviously, yes, we're still in this trend. We're talking, if we were using something like a 60-minute, we don't have any trend here yet. We're still range bound inside all this trash. One spark, we could get to the high here, 194.5, and break through. For the target on that, it'd be the same thing. Just measure the zone, right? $197.80 and $201.30. $198 and $202. Meta finally started to pull back a little bit. I would be cautious on trying to short this thing in the long term. In the short term, we're actually looking at another down day. We closed at 308.87 and we're at 306 this morning. So we are inside day breakout to the downside. I would be watching for today to be another one of these kind of days. Okay, remember earlier when I talked about buying puts while we're still going up and buying calls when we're still going down? Buying calls while we're still underneath that level and maybe even still going down, wouldn't be a bad way to go if you still believe that there's a turn here and we're not done in meta and that we're going to continue to go up. That's especially with all the other fangs up this morning. Kind of like that. Let's see what the puts cost on meta. Some calls and some puts here. That's a little pricey. It's not bad. Top of the range. $3.15. They'll be a little cheaper since, this is old data. It's not exactly accurate, right? We got to see the numbers when we get into the open. But a 315 call, about $1,500 for 32 days out. If you're looking at that and you think it's a little much, then just turn it into a spread. You're going to risk about $200 for an opportunity to maybe make 300. Now, to be fair, you don't get max profit in debit spreads unless you run it into the money and take assignment. And I mean, who would do that, right? So don't go for max profit. If you aimed for 50%, then you want to not risk 100%, right? So if try to go for like a 1-to-1, risk half of this to make half your reward. So risk $1 to make $1.50. Hey, that's still more than 1-to-1. It's not bad. Could go wider, and you could go a little farther out of the money. Just remember, the farther out of the money you go, the more you're relying on the Greeks and the less you're relying on the price move. If you are deep in the money, then you're trading a synthetic stock. And the option is going to change in price very much like the stock will change in price. It does look like a head and shoulders, doesn't it? It's a little sloppy, but it's there. We are still 3% above the 10-week in the ES. But we are coming back off of it, right? So this is saying we still anticipate a market in pause or a market that's going to remain weak until it kind of resets that 10 like it did back here. And we didn't really get bearish, right? We just stopped being bullish for a little bit. And we got bullish again, and now we're kind of sideways again. But we're still holding above that 10. So it's not like we're going to get all bared up. And we're 0.82%, not even a full 1% away from the 10-day, which means we're not overbought. We haven't moved too far too fast, and you don't want to short this thing just because we had 4 green days in a row, right? Because those last, well, Friday and a little bit of weakness this morning is showing us that we're not overbought here, right? You can see where we got, more overbought back in that October recovery into November. And right, remember the October 21st reversal and that October low back here with the Bank of Japan intervention, blah, blah, blah back here. All right, guys, be careful, be safe, have a good day. I will see all of you tomorrow. A couple of things to check on through the day, right? Bitcoin had some solid, crazy moves because of a lawsuit last week. It wasn't Bitcoin that had the suit. It was a different one, RXP or something like that, RXT. Either way, they had a crazy move to the upside, and those names are kind of pulling back. So Riot, Mara, Coin, and then the EV plays. So Lee, Ride, Auto, XPEV, all of those are worth keeping your eye on. Individualized groups, right? Semis. So semiconductor ETFs, NVIDIA, AMD, Intel, Taiwan Semiconductors, and then the airlines. Not counting what's going on in the banks. Oh yeah, they're getting whacked right there. So that's JetBlue, right? Smackdown. What we're looking at here with that cyan line is an anchored VWAP from the first of the year, right? And simple metrics, if we're above it or if we're below it. Well, we are above it, but we're headed for it, right? And this morning, I mean, we're kind of flat. We haven't done anything yet, but I don't think that's very much. So I'd say, guys, see you tomorrow. Be careful. And I don't know, it's Monday. Let's start off the week good.